Well, let's dig deeper into our top line story with key takeaways from the quarter of the banks. Of the 3 banks that have reported, 2 have exceeded earnings expectations and all 3 have raised their dividends. That's the good news. Profit growth, however, was non-existent for each of the banks, and 2 of the 3 set aside more money for potentially bad loans than they did in the previous quarter. One bank, TD Bank, says it will be, quote, challenging for it to meet 2024 financial targets that it has earlier set for itself. For insight, let's go to our featured guest of the morning. He's Brooke Thackray of Horizons ETF Management Canada. Brooke, it's always great to have you here. Let's just show viewers a bit more about these numbers. We'll start with TD Bank. It is, I think, one of the most notable ones. It has missed earnings expectations. Provisions for credit losses rise in the third quarter. There's nothing terribly unusual. Rise in the fourth quarter from the third quarter. Nothing terribly unusual about that. Of the 4 banks that have reported, 3 have reported an uptick in PCLs in Q4 versus the prior quarter. What's notable, however, is that TD says that meeting its 2024 financial targets will be challenging. Specifically, it says it will be challenged to meet its target of adjusted earnings per share growth of between 7% and 10%. And a return on equity target of 16% plus. Profit was down in both Canada and in particular in U.S. retail banking. The bank did, however, raise its dividend. Here's a quick look at Royal Bank of Canada. Royal Bank of Canada has beat earnings expectations. Provisions for credit losses rise versus the third quarter. The dividend did go up and profit was down in its big personal and commercial banking segment by about 2%. That's a fairly common outcome. Here's a quick look at CIBC. It has also exceeded earnings expectations. Provisions for credit losses decline from the third quarter level. Profit was essentially flat in personal and commercial banking for CIBC, and there was a dividend increase there as well. So, Brooke, a lot to take in there. This earnings season got off to a rocky start with Scotiabank earlier in the week. Any quick thoughts on what we're seeing here today?
Well, this is their full year earnings, of course. So
yep.
The Q4, they had their October 31st as a year end. And so you have to wonder, is this the kitchen sink earnings?
Right.
So they're throwing everything in here and saying, look, let's just get this over with, and let's get it out there so we can move forward. And investors, we saw the market, the Canadian banking sector actually do quite well yesterday because I think investors said, hey, maybe, we overreacted to Scotia. So it's going to be interesting to see what happens today. Looking, obviously, TD is a loser here. I was a bit surprised to take a look at their U.S. retail business, ex-Schwab, so I take out Schwab, down 12%, which was surprising. Yeah, it's a mixed result to see, such a big discrepancy between TD and Royal and CIBC.
It's interesting that the other banks are not cautioning on their ability to meet their targets, as is TD Bank. What do you think the takeaway is there?
Yeah, that's once again a discrepancy here, to say the least. Maybe TD is taking more of that. Let's throw everything in the kitchen sink and let's get it out in the open here more than the other banks.
CIBC, an outlier here in the sense that it like Royal, topped earnings expectations. The bank says that provisions for credit losses were $541 million. That was up from the prior year, but down from the third quarter. And most analysts track provisions for credit losses on a sequential basis, tracking them quarter to quarter. And there's no doubt, Brooke, that CIBC aside, we are seeing these banks take a more cautious view of their loan books as Canadian consumers are stretched by higher mortgage payments and higher inflation as well.
Yeah, banks are typically fairly conservative. The Canadian banks are conservative in doing this. They tend to take on a lot more credit losses, provisions for credit losses. And in doing this, they don't try and shuffle them off a little bit. CIBC probably has the biggest exposure to the residential real estate market as well. So I haven't worked out the numbers as far as their exposure versus, let's say, for instance, TD and how it's affecting their provisions.
What would it take to get these bank shares moving higher in 2024? It's very unusual for the banks to drift sideways or decline for 2 consecutive years.
I think if we see an environment where we have a soft landing and we do see interest rates start to come down, I think that would be the big thing in Canada for Canadian banks. If we start to see the Bank of Canada start to say, okay, we're going to look, we've raised rates a lot. We've paused here. It's doing its job. It's going to do its job over time. We can bring back the interest rates a little bit. I'm not saying they should do that, but if they do that path, and a lot of people are calling for that, that would actually, I think, give the banks a boost. Before we used to talk about interest rates when interest rates were rising. They were providing greater, profit margins. And that was a good thing.
Yeah.
But now it's not a good thing. We need to see interest rates going down.
Yeah, it's blunting loan demand, and it's putting stresses on the loan book, correct?
Absolutely, and also they're having to take their greater provisions for credit losses because of this. So, I think Canadian banks will react to expectations if the expectations are for lower interest rates in the future.
And we're seeing TD Bank announce job cuts, some 3% of its workforce. The banks, interestingly, coming into this quarter, was noted by analysts that most of the banks have increased, their expenses have risen significantly at these banks, and sooner or later they come under pressure to cut costs, and unfortunately, some employees will pay the cost.
Yeah, it's interesting. TD, did cut their employee count, and the other banks didn't. But we're seeing that in the States, where some of the banks, the big banks in the States, are trimming their employees as well. So it's not unusual to see this. It's not like TD's the only one that's doing this. It's just that Royal and CIBC didn't do this.
The dividends remain a good story. The yields on the Canadian banks are higher than they've been typically. TD Bank announcing a dividend increase today to $1.02 per share per quarter. That's up from the 96 cents that the company has paid until now. The dividend yield on TD Bank is 4.8%, and on Royal Bank of Canada, the dividend yield, Royal's also announced a dividend increase, 4.5% is the dividend yield on Royal Bank of Canada. The dividend at Royal will go up the next time it's paid to $1.39 per share per quarter from the $1.35 that it is paid until now. And CIBC has announced a dividend increase to 90 cents per share per quarter. That's up from the 87, I believe, that it was paying previously. And the yield on CIBC, believe it or not, 6.7%. What do we make of these high dividend yields on the Canadian bank stocks?
Well, they've actually come down a little bit as the bank prices have moved up here a little bit. But that helps the bank stocks, actually, the high yields, because investors are saying, well, I'm going to get paid to wait.
Right.
And it's a positive sign that we've seen all three banks actually come out and make an announcement to say, let's increase our dividend. If they thought they were in serious trouble, they would have held back a bit. But this is a positive sign overall, despite the bad news with TD here. Okay.